As the Federal Reserve prepares to convene this week, the world of finance is abuzz with anticipation. For the first time in over 4 years, the central bank is poised to lower interest rates, marking a crucial pivot in its monetary policy. This move, expected to be a quarter-point reduction but potentially as significant as a half-point cut, signifies a watershed moment in the Federal Reserve's efforts to navigate the U.S. economy towards a rare and coveted soft landing. The decision to cut rates is underpinned by a complex interplay of economic indicators. Inflation, though still a concern, has shown signs of cooling. The Consumer Price Index, CPI, has dropped to 2.5% over the past year, a significant decline from the peak of 9.1% in 2022. This trend, coupled with a weakening labor market, has created an environment in which the Fed feels comfortable easing its grip on the economy. The labor market, however, remains a point of contention. Unemployment has ticked up to 4.2%, higher than the historically low levels seen in the preceding years. The SOM rule, a well-known indicator that signals potential recession when the unemployment rate rises by 0.5 percentage points above its low point over the previous 12 months, has been triggered this summer. This has raised red flags among economists and investors, who are now keenly watching the Fed's next steps. The anticipated rate cut is not merely a technical adjustment, but a signal of the Fed's readiness to provide relief to American businesses and households. Mark Zandi, chief economist at Moody's Analytics, encapsulates the sentiment. This is a big plus for Americans and the entire global economy. It goes a long way to take the Fed's boot off the economy's neck and allow it to move forward. The move is already reflected in higher stock prices, a testament to the market's positive reaction to the prospect of reduced borrowing costs. However, the path ahead is fraught with uncertainty. Investors and economists worry that the Fed may have waited too long to act, potentially putting the labor market and economic growth at risk. The November presidential election adds an additional layer of complexity, with politicians weighing in on the Fed's decision-making process. Former President Donald Trump has cautioned against rate cuts close to the election, while Democratic Senator Elizabeth Warren has urged more aggressive rate reductions. Market participants are eagerly awaiting the Fed's announcement, not just for the rate decision but also for the accompanying projections and forecasts. The dot plot, a graphic representation of policymakers' expectations for future interest rates, will be particularly revealing. It will show how many Federal Open Market Committee, FOMC, members favor additional cuts in the coming months, and whether they anticipate these cuts to be significant, perhaps even half-point moves. Traders have been aggressive in their outlook, pricing in more than a full percentage point in rate reductions by the end of 2024. This optimism is driven by the recent economic data, including a disappointing July jobs report that hinted at a weakening labor market. By the end of 2025, markets expect the benchmark rate to be below 3%, a significant shift from the current levels of 5.25% to 5.50%. Fed Chair Jerome Powell's press conference will be closely scrutinized. If the committee decides on a cautious quarter-point cut, Powell will likely need to reassure markets that the Fed is prepared to act more decisively if labor market conditions deteriorate further. His recent statements, particularly his August 23 speech at Jackson Hole, Wyoming, have hinted at this readiness, emphasizing that the Fed would not seek or welcome further cooling in labor market conditions. Powell's colleague, Fed Governor Christopher Waller, has been more explicit, stating that additional labor market weakness would necessitate quick and forceful action. This balance between controlling inflation and supporting the labor market is a delicate one, and Powell's words will be parsed meticulously by investors and analysts. The Federal Reserve's task is not without precedent, but success is rare. The central bank has only once managed a clear soft landing in its history, during the mid-1990s. More often, rate hikes have led to economic downturns, with 6 recessions over the past 50 years resulting in an average unemployment peak of 8.6%. The current environment, while challenging, offers a glimmer of hope. Despite the recent downshift in the economy, with hiring stalled and job vacancies at their lowest since 2021, the overall picture remains resilient. Unemployment, though higher than in recent years, is still relatively low. The housing market, although squeezed by higher mortgage rates and soaring home prices, has not yet collapsed. The Fed's pivot signals a new chapter in its monetary policy, one that aims to balance the dual mandate of maximum sustainable employment and price stability. The next few months will be crucial as policymakers navigate the fine line between supporting the labor market and keeping inflation under control. For investors, the immediate focus will be on the market reaction to the rate decision and the accompanying projections. A quarter-point cut, while likely, may be seen as a cautious move, and market reaction will depend heavily on how officials spin this decision. A half-point cut, though less probable, would be a more decisive signal of the Fed's intent to provide significant relief. In the longer term, the Fed's actions are expected to influence a repricing of trillions of dollars in global assets. This repricing, already underway, reflects market expectations of lower interest rates in the future. By the end of 2025, the benchmark rate is expected to be below 3%, and by 2026, the federal funds rate could drop to around 1.75% to 2.00%, significantly below current levels. The Federal Reserve's decision to lower interest rates this week marks a pivotal moment in the U.S. economy's journey. As policymakers embark on this rate-cutting cycle, they must navigate a complex landscape of economic indicators, political pressures, and market expectations. The path ahead is uncertain, but one thing is clear: the Fed's actions will have far-reaching implications for Americans and the global economy. In this delicate dance, the Fed must balance its dual mandate with the need to avoid triggering a recession. The stakes are high, but the potential reward, a soft landing and sustained economic growth, is worth the risk. As we watch the Fed's next steps with bated breath, one thing is certain: this is a moment that will shape the economic future of the United States and beyond.